So what's the difference between high resistance liquidity and low resistance liquidity, and what do they mean and how can we use them? Low resistance liquidity is the liquidity that's easy for price to reach. These are your equal lows, clean swing lows, obvious stop clusters, and just the levels that the algorithm can reach with almost no effort. So low resistance liquidity is where price wants to go. It's where liquidity is sitting. Now high resistance liquidity is the liquidity that's harder for price to reach. Think of things like protected highs, highs that already swept liquidity, highs that are inside of a fair value gap, and essentially just highs that would require a true structural break to reach. High resistance liquidity is where price should not go if your trade idea is correct. So how do we actually incorporate these into our trading? Simple. You want your stop loss to be at high resistance liquidity and your take profit to be at low resistance liquidity. If you're longing, you want your stop loss underneath a low that would require a true displacement to break. That's high resistance liquidity. But your target is at the obvious generated liquidity above. That's low resistance liquidity. Once you start placing your stops at high resistance liquidity and targets at low resistance liquidity, you'll instantly filter out low probability trades and understand why price kept hitting your stop loss.